Dividend stocks are losing you money. Many believe that buying dividend-paying stocks and reinvesting the dividends will provide a steady stream of passive income. So how come they're actually costing you? After hours of research, expert interviews, and taking 34 pages of notes, I've uncovered the 8 biggest problems that can cost you millions when relying on dividend investing for passive income. And by the end of the video, I'll reveal a much better way to build wealth. Imagine waking up to a steady stream of passive income of $2,000 or even $5,000 every month. Many YouTube videos showcase this dream, painting a picture of buying dividend stocks and sitting back while the money rolls in. But here's where the story takes a turn. What those videos often gloss over is a crucial detail that can turn your dreams into a long, hard reality. You might be thinking you can start earning big dividends quickly, but the truth is potentially discouraging. To earn $2,000 a month in dividends, you'd need an investment portfolio worth $800,000 if you're relying on a well-known dividend stock like Johnson & Johnson, which boasts a dividend yield of 3%. This means you would need to save and invest $500 every month for 28 years, with every dividend penny reinvested to reach that goal. And keep in mind, $500 in 1995 was a significant amount, representing almost 20% of the median income at the time. So while these videos make it sound so easy, the reality is that building this kind of passive income is a long-term commitment that many of these videos downplay. If you're enjoying the video, like and subscribe. Tell me in the comments below if you're a dividend investor or not. This leads us into the second problem that can quietly sabotage your financial dreams. The idea of earning $2,000 or even $5,000 a month without moving a muscle is undeniably enticing. But there's a crucial factor lurking beneath the surface that could completely undermine your plans for financial freedom. Many investment guides conveniently forget to mention this essential concern, leaving you in the dark about the true future value of your hard-earned money. As you chase that passive income dream, it's easy to overlook how the world around you is changing, particularly in terms of cost and purchasing power. While $2,000 a month sounds like a comfortable income today, have you considered what that would look like in 10, 20, or even 30 years? Inflation is an invisible force that can quietly strip away your buying power. Factor in a 3% average inflation rate, and in 30 years that $2,000 would need to be more like $4,854 just to maintain the same standard of living. The income that feels substantial today could feel frustratingly inadequate in the future. Dividends might seem like the golden ticket. They offer you the flexibility to decide how to allocate your shares of the profits, whether to use them as income, reinvest them in promising new ventures, or funnel them back into the same company you believe in. But there is a crucial downside that comes with that. While inflation steadily erodes your purchasing power, there's another threat that can start eating at your wealth from day one, a factor that could significantly diminish your earnings regardless of how well your investments are doing. Dividend investors frequently tout the power of compounding, celebrating how it can amplify returns over time, creating the snowball effect. However, many investors overlook a critical factor. Dividends can trigger taxes, fees, and charges that quickly erode your profits. Over time, these small costs compound, leading to a significant reduction in your overall returns. It's no surprise that investors are drawn to established names like McDonald's, Johnson & Johnson, and Coca-Cola, often referred to as dividend aristocrats. Their decades-long track record of consistently increasing dividend payments provide a sense of comfort and stability, making you feel like you're securing a reliable stream of income. While the notion of steady dividend income is appealing, it's essential to ask, how safe is that income really? Relying solely on dividend-paying companies comes with risks that can be ignored. Economic fluctuations, competitive pressures, and changes in consumer behavior can all impact a company's ability to continue paying dividends. What happens if a company you trust suddenly finds itself in financial trouble? Dividends are discretionary payments, not guaranteed. Companies, even those with long-standing reputations, can and do cut dividends. Take General Electric for instance. After over 119 years of paying dividends, they shocked investors by cutting theirs in 2019. By focusing solely on dividend stocks, you risk jeopardizing your financial future and might end up with lower income than you anticipated. Let's say you're still determined to pursue dividend investing, even after understanding the risk and potential rewards. You believe that with the right picks, you can build your wealth over time through a steady stream of dividends. In the US, there are around 13,600 publicly traded companies. The idea that some of them must have outperformed the S&P 500 over the past 20 years while paying dividends might sound plausible at first. However, the reality is far more challenging. Out of those thousands of companies, only about 805 companies, roughly 6% of all listed companies, have managed to exceed the returns of the S&P 500. Now let's narrow it down even further. How many of these companies pay dividends with a yield of 2% or more, which is often the target for dividend-focused investors? That number dropped to around 156 companies, representing a little over 1% of the entire US stock market. Consistently picking dividend stocks that can also outperform the market is an incredibly difficult task. Are you really willing to bet that you can find these elusive 1% dividend-paying companies that will consistently deliver superior returns? Stocks that pay dividends often appear to offer a lucrative bonus you get from capital appreciation while also receiving regular dividend payments. However, the reality is more complex. Imagine you're considering investing in a tech company called TechCo, currently trading at $150 per share. On March 1st, the company announces it has generated $6 in excess cash per share for the quarter. They decide to invest $2 back into the business for research and development, while distributing the remaining $4 as a dividend to shareholders who own the stock by March 15th. To qualify for the dividend, you need to purchase the stock by the end of March 13th. Given that stock transactions typically take 2 to 3 days to settle, the ex-dividend date is set for March 14th, marking the cutoff for receiving the dividend. So what does this mean for the stock price? On March 13th, TechCo's stocks is expected to trade at around $156. This price includes the expected future earnings of $150, $2 retained for growth, and the $4 set to be distributed. However, after the ex-dividend date, new investors won't pay a premium for the dividend they can receive. Consequently, the stock price is likely to drop to approximately $152, reflecting the $150 in future earnings and the retained $2. While dividends may seem like a bonus, they effectively reduce the stock price. This isn't free money, it's the company's earnings returned to shareholders. Dividend investors often believe that the secret to success lies not in chasing high yields, but in pinpointing companies with a track record of consistently increasing their dividends. They frequently cite dividend aristocrats, those elite companies that have raised their dividends 25 consecutive years, as shining examples of financial health and stability. However, there is an unsettling trend lurking beneath the surface of this seemingly solid strategy. Consider UPS as a case in point. During a recent period, the company's earnings per share grew by a respectable 39%, while its dividends sold by an astonishing 95%. This glaring disparity raises an important question. What happens if UPS continues this pattern of dividend growth? The risk is clear. The company could end up paying out all of its earnings, leaving no funds available for reinvestment in growth. This pressure to maintain or grow dividend payouts can create a detrimental cycle, pushing companies to prioritize short-term distributions over long-term growth investments. As a result, they may miss out on valuable opportunities that could enhance their future earnings potential. Investing in stocks that offer high dividends sound like the perfect passive income strategy, but over time this approach can lead to millions in unrealized gains. When comparing the S&P high dividend yield with the standard S&P 500 over the past decade, the high dividend yield returned just 7.49%, while the S&P 500 achieved an impressive 12.33%. That 4.84% difference might not seem significant initially, but over time it adds up to a monumental impact. Consider two investors, Michael and Jordan. Both are 25 and start with $30,000. Michael, drawn in by the allure of dividends, invests in the high dividend yield one, while Jordan opts for the standard S&P 500. Fast forward 40 years, Michael's investment grows to around $540,000, but Jordan skyrockets to an astonishing $3.1 million. That's a $2.56 million gap simply by prioritizing growth over dividends. Remember, total returns are what truly matter. While high dividend stocks might provide tempting payout, many fail to outperform the S&P 500 in overall returns. Before you jump to conclusions about my stance on dividend stocks, let me clarify. I'm not against them. My goal is to provide you with a comprehensive understanding of dividend investing. Many YouTubers tend to focus only on the positives, but it's crucial to also acknowledge the possible downsides. Investing is a personal journey. What suits one investor might not work for another. While I'm not a financial advisor, I encourage you to consider the bigger picture. By concentrating solely on dividends, you risk missing out on substantial long-term growth opportunities. Extensive academic research and compelling evidence point to one reliable strategy for most investors: low-cost index funds. If your aim is consistent long-term growth, low-cost index funds are the way to go. Index funds offer dividends for those who love the idea of cash payouts, all without sacrificing total returns. You get the best of both worlds. However, to unlock their full potential, it's essential to know which funds to invest in and what common mistakes to avoid. Click on this video to ensure you're on the right path toward financial freedom.